eBay is a classic example of a historically strong growth stock that has recently started paying a dividend. As you can see, the company's earnings have grown from 99 cents in 2012 to $4.02 in 2021 and estimated to be $4.12 this year. The growth rate has averaged over 13% historically, and if we add weekly closing stock prices to the graph, you can see that prices have tracked earnings. But recently, the stock was overvalued in 2021 because of a flattening of earnings expected in 2022. The stock has fallen precipitously, creating a strong margin of safety. One of the things that's attractive here is that the company does have a strong margin of safety, which reduces risk, but it's also a stock that is beginning to revert back to the mean and start to recover. Again, the company's paid a dividend since 2019, and so far it's raised it every year since. Offers a 1.8% yield. It's BBB plus rated, which is one spot short of A rated. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. You know, valuation is such a very important factor. We've entered here into some kind of uncertain economic times. Actually, with uncertain economic times, valuation and then margin of safety, those two principles that I talk about quite often as a value investor, become even far more important. So what I've done here today is I've created a portfolio of research candidates of stocks that I consider good dividend growth stocks with, good quality characteristics, decent yields. All but one of them has a yield higher than the S&P 500 right now, a dividend yield. But what I like most about these 5 candidates is they all have a built-in margin of safety currently, which simply means I think the risk is already discounted in their price. And there's not a lot of downside risk in the future as we enter these uncertain times, but there's a lot of upside. So let's take a look at the portfolio, if you will, through FastGraphs. The companies I'm listing here are Brunswick, BorgWarner, Comcast, eBay, and Polaris. 4 of them are consumer discretionary stocks. One of them is in communication services, Comcast. It's the highest rated at A-. So we've got leisure products, auto parts and equipment, and cable and satellite, internet and direct marketing, retail, and again, leisure products with Polaris. So let's go through these companies. I'm going to do this on a high level here because I'm covering 5 companies. Again, these are research candidates that if you're looking for total annualized rates of return in the future, you can see that all of these offer double-digit rates of return going forward. eBay actually has the lowest expected total annualized rate of return. And I'll show you how I come up with these numbers as I go through these stocks. The highest total annualized rate of returns would be in through Brunswick, followed by BorgWarner, and then Polaris, and then Comcast, and then finally eBay. All of these are investment grade stocks except Polaris, which doesn't really have a credit rating, but it's a good quality. It's one of the highest quality stocks, I think, in this portfolio in the leisure product sector and the consumer discretionary sector. So let's go ahead and take a look at these in alphabetic order, one at a time. We'll start with Brunswick Corporation. Now, I'm going to run these charts as about a 14 or 15-year chart. I want you to know that Brunswick has grown at a very attractive over 21% a year. But historically, the market has priced this stock at a 15 PE. And I want you to notice that every time you see the PE ratio fall below 15, these have always been good times to buy the stock long term. We currently have a very strong margin of safety built into the stock. In other words, if Brunswick were to go to its forecast numbers, that would be the 30-some% annualized rate of return that I was referring to, and that includes dividend income. We got very strong capital appreciation potential, and we've got good dividend growth potential as well. The dividend yield is 1.83% currently, and again, the company's BBB- rated. Now, what I'm really focusing on here is the margin of safety. Now, relative to a growth rate PE ratio, that's a little strong for this company. As you can see, as I shorten the time frame, we get closer to a more normal 15 PE ratio that this stock should be trading at. So somewhere between 14 and 15 times earnings would be the actual value of the stock. I believe the stock is already beginning to show some potential moving back to reversion of the mean. It is paying a dividend of 1.83%. So looking at it from an operating cash flow point of view, I want to see the operating cash flow, which is the orange line on this graph, significantly higher in this case than the dividend. So there's a lot of room for dividend growth. And the cash flow payout ratios are only about, really some cases single digit. So there's, a lot of room for the company to be able to continue to raise dividends going in the future. I like this company very much for the margin of safety. Looking at it from a free cash flow point of view, which is the real acid test, we've also got strong free cash flow coverage, a little bit of volatility, but I'm not so much concerned with price here as I am dividend coverage. I've got a 1.83% dividend yield. Now, with fast graphs, you can go into the company's website directly and you can learn about the company. So I'm offering these as research candidates, companies that you should research further. And as you can see, this is really all about the Mercury engines. It's a leisure product company. Leisure products, I think, one of the reasons why these companies each have a margin of safety, as well as, like Brunswick does, is because, when we're getting into uncertain economic times, leisure products would be considered, or consumer discretionary would be considered some of the first things to cut. But I think that risk is already priced into these stocks. Looking at the forecasting calculator, and here's how I come up with those rates of return that I showed you in the portfolio review by simply pointing to the last forecast out here. The company is expected to grow at double-digit rates going forward on average. You can see 4% for 2023, 8.8%, and then 5%. But it's expected to come in at 21% this year. But you've got strong growth potential and a stock that's very undervalued. Even looking at a normal multiple, which has been below 15, you still have a very attractive, over almost 30%, 29.8% annualized rate of return. So I like Brunswick very, very much as a company that gives us a margin of safety, a very strong margin of safety, and still has very strong fundamentals. The next company is BorgWarner's. BorgWarner is auto parts and equipment. It's very strong in electric vehicles, and it's kind of poised for the future. Again, we have a very strong margin of safety. We have a stock that's already began recovering. We have a 1.47% dividend yield. This is slightly below the market, but I do believe the dividend growth potential here is very strong. The company's dividend payout ratios are very low. Looking at the company from a forecasting point of view, it's forecast to grow at 11%. And given the margin of safety, that gets you almost a 29% annualized rate of return. Looking at the normal multiple, which is only 11, still gives us a margin of safety and would still indicate an 18.39% rate of return. So I think we've got a best case, worst case scenario here. I think the real key is anytime you could buy this stock below value, you would eventually done well. Earnings growth is expected to be strong. And again, once again, let's look at it from the standpoint of operating cash flow, very strongly covering the dividends. Let's look at it from a standpoint of free cash flow. Free cash flow is well covering the dividend. So we've got a dividend growth stock here with a strong margin of safety relative to its intrinsic value. Now, you can also go into other sites. I happen to subscribe to Morningstar and look at these companies and research them further besides going in. As you can see, Morningstar gives BorgWarner 5 stars, which indicates that they see a fair value of 78, which is that margin of safety here, and it closed at 46. If you looked at fast graphs from a standpoint of adjusted operating earnings, we would give this company a fair value of about $66 a share up to $72 a share. So slightly more conservative than what you see on Morningstar. Again, a 1.47% dividend yield. Comcast, I've covered this recently. The stock does have some subscriber issues, but it's a very broadly diversified company. If you look at this one again through Morningstar's eyes, as an example, it's another 5-star rated. They give it a fair value of 60. Last close is $39 a share. I think the real margin of safety here, and there has been some bad news which created this drop in price, which gave us this strong margin of safety. The market has historically put a premium valuation on this company. So looking at it from a standpoint of the forecasting calculators, looking at it going to a 15 PE, we got a 22% rate of return. If we look at it from a closer to a 16 PE, we also get a 23% rate of return. So I think Comcast is beginning to move back into its normal alignment. I think there's a strong margin of safety here. I do believe earnings are going to be decent going forward. In spite of some of the current trouble, it's A-rated. It does offer almost a 3% dividend yield. So if you're looking for dividend income, I think it meets both the quality of a relatively high yield with good, strong dividend growth. If I look at its long-term performance, its dividend has, slightly outperformed the S&P 500. It's grown about 12% a year. And remember, the S&P 500 is overvalued now, where I consider Comcast to be undervalued, but moving back into fair value, it's starting to look like anyway. So I think this is worth some time. eBay has recently started paying a dividend, and they've grown the dividend every year since they've paid one. Interestingly enough, analysts aren't expecting any dividend growth, but I think that's simply because of the short history. The company offers a 1.8% yield. It's BBB plus rated. And I believe at this valuation level, it has a very, very strong margin of safety. Earnings growth is expected to slow down, but that still gives us a very strong, potential rate of return going forward, whether you look at it based on its normal PE or its historical PE. Now, historically, if I use a shorter time frame here, the market has, valued it at around this 15 multiple. And again, it's very cheap, and you can see it's starting to recover. So I like eBay, very much at these prices. The dividend payout ratio, again, is under 20% or just barely 20%. So I think there's a lot of room for the dividend to grow and for the capital appreciation to occur. Polaris, one of the leading manufacturers of things like snowmobiles and jet skis and ATVs and, off-road vehicles, etc. It's, motorcycles, the leisurely products company. What's happened with Polaris, we saw the price drop. We got it way below fair value, in my opinion. It's got a very good margin of safety. It's got about a 25 to 30% annualized rate of return going forward. The company does not have a credit rating like most, but it does offer a 2.4% dividend yield. And the dividend yield has grown, very nicely. It's kept up with the S&P. It's had an 11% average dividend growth. But I want to make a point. We're measuring this against an S&P that remains overvalued, and this stock is now undervalued. And so it's underperformed. But, as Warren Buffett said, you want to be greedy when others are fearful and fearful when others are greedy. Now's the time, I think, to be greedy on a stock like Polaris here. So anyway, this has been Chuck Carnevale, just a kind of a quick video for you this week. I wanted to show you some stocks with a margin of safety. This margin of safety principle, I believe, is so very vitally important, and I'm going to be focusing more on margin of safety, and I plan on some future videos actually talking about investment strategies that are built and founded and incorporated under the margin of safety. As we come into uncertain economic times, margin of safety is critically important. Valuation is always important, and I think we've learned some lessons looking at this long-running bull market that we've had, where all of a sudden you've seen all these stocks that have corrected so much since this kind of bear market has kind of reared its ugly head, and that's because valuations were extended. The opposite is true. The reversion to the mean, when you can buy stocks at a good margin of safety below their intrinsic value that still have good, strong fundamentals like the ones I've shown you here, these 5 companies, put you in a long-term position to have minimal downside risk and outsized rates of return going forward, thanks to the double-powered combination of good value and margin of safety. Hope you enjoyed this video. If you have, ring the bell, subscribe to the channel, and obviously take a look at Fast Graphs. It's such a marvelous tool that can help you make sound, prudent investment decisions going forward. And the more uncertain the economy gets and the more uncertain the stock market gets, I think the more important it is to arm yourselves with good research products, and I think Fast Graphs is one of the best, even though I did build it. Thanks for watching. Talk to you again real soon.